Good morning, Propenomix people. Hello, and apologies that I haven't been able to do a live for a few weeks. I have been absolutely inundated with things to do. If you were going to blame anyone, I would blame Rachel Reeves for her October budget. Of course, I would. But in joking aside, it's caused quite an amount of disruption in a number of businesses that I'm involved in or that I'm consulting for. And so that has kept me so very busy. I've just not been able to record a video, but hoping to get back into a routine of at least fortnightly, if not weekly. So hope there's something useful in here for everybody. If you've watched one of these before, if you haven't, you might know I like to start with a quote. And this week's I used was, "The next Labour government will deliver the biggest boost to affordable social and council housing for a generation. We'll start by rebuilding the dream of a safe, secure, affordable home." That was from Angela Rayner on October 2023, when she was deputy leader of the opposition. And this is directly pertaining to the deep dive this week, which is talking about the real numbers needed in order to build social rent homes in the UK at any sort of scale. So before I go full throttle into this week, Rod and I are running another workshop in July, Thursday the 3rd, joint ventures and mergers and acquisitions this time around. Sure to be highly popular. Here's a quick whistle-stop tour of the agenda. We're going to talk about market dynamics, JV opportunities, optimal legal structuring for property businesses, pros and cons of limited companies, share classes, shareholder agreements, and sustainable JV models, diving into capital structuring, comparing debt to equity, managing risk, and understanding personal guarantees. There'll be some insight into property mergers and acquisitions, from due diligence all the way through to asset versus share purchases. Applying concepts through two in-depth case studies, two real ones that we've actually done, acquiring an asset-backed property company and also navigating a distressed business sale. So understanding strategic disposals, wind-ups of companies, and how to negotiate under pressure while still maximising value. We still have early bird tickets available. So there's a genuine 10% plus discount on those early bird tickets, and they are at bit.ly/PBWSEVEN, and there'll be a link below in the comments as well. So it was an interesting week last week. Trump Watch seems to be taking a bigger and bigger part of the supplement at the moment, but had to do probably the biggest piece I've done on Trump Watch so far, because there's, as usual, a lot of misinformation going around on the internet, and I thought I would try and set the record straight with what's really going on. So I'd shared a bit of content about the US Treasury participating in a big way in bond issuance, right? So they bought back about $10 billion worth of debt last week that was issued. But I'm sure some of this is deliberate confusion, really. Now, you might know, although 10 billion is an unfathomable amount of money to all of us, unless there are some billionaires watching, then it's not a huge amount of money within the scheme of $37 trillion worth of US national debt. Now, the US has got 9.2 trillion, so around about a quarter of their debt maturing in the whole of 2025. And all of that, plus some more, because they're in a deficit, of course, needs to roll over. So at this time, the yield curve's fairly flat and slightly inverted in the US up to 3 years, which is suggesting that the short-term rate maybe is a little bit too high. And then it starts to climb again and look a bit more normal. Their longer dated debt, which is 20 and 30 year in the US, hikes quite a bit to 5% yields. Their 10% is about 4.5%. So if you imagine what that means, that would mean the 10-year in 10 years' time would be about 5.5% in the US, right? So that means the first 10 years are at 4.5. We know that because of the 10-year price. The second half is at 5.5. That averages out at about 5%. Maths isn't perfect there, but it's close enough for the example. So if we go back 20 years, June 2006, the 10-year was only at 5.1. And it was volatile, but generally it moved downwards until the implosion of the financial system in 2008. So 5.5 is expensive, make no mistake, for 10-year debt, as when and if we get there. And indeed, the UK is no better off. In fact, it's slightly worse. Our 20-year trades at 5.25. Our 10-year is 4.65. So in 10 years' time, that makes our 10-year, best guess, 5.85%. Now, that's really expensive, and it makes long-term debt much less viable. In June 2007, we were at 5.45. but the 20-year was 5.07, which was meaning the best guess for the 11 to 20 year at that point was 4.69, which is really weirdly very close to the current yield, but it's nowhere near the June 2017 10-year, which was 10 years after 2007, of course, which was 1.33, which is what actually panned out. But as we know, 325-year low in interest rates, etc., etc. And again, I've cherry-picked that high point there, although it does happen to be nearly 20 years ago, 18 years ago to be precise. But fiscal drag on the economy at that sort of 5.85% cost for the debt would be incredibly harmful. The debt forecasts are for an upward trajectory with debt at 274% of GDP by the mid-2070s if current policies remain unchanged. Yes, that's from the Office for Budget Responsibility. So let's say government debt sits at about 3.5 trillion by that point, and I mean in 10 years' time, that's the forecast, right? The most liquid and active gilt market would see us paying about 205 billion just in interest, and then we'd also be borrowing more if we were still in deficit. Now, only pensions and welfare see more money spent on them, 276 billion in the last fiscal year just completed. So flip that on its head for the moment. Short-term debt looks cheaper in comparison. And if you have to issue debt, let alone buy your own because nobody wants it or there's not enough demand for all of it, and you're rolling over some old debt, now 38.6 billion of Fed-owned securities expired just in the week ending June the 5th. That's the scale of what they're dealing with. So 10 billion, and a quarter of that going to the Federal Reserve, is not an incredible disaster, especially if older securities rolling over were longer dated and it would cost a lot more, 5% plus, rather than the current rates, 4-ish%. It does make sense to buy that debt yourself to an extent. I mean, it's playing the system a little bit, but central banks have been playing the system for many, many years, especially since we've been off the gold standard. So buying that new shorter debt rather than the longer term debt that's more expensive does make sense if you believe that longer term debt yield will come downwards and the term premium, that's the term we use, the extra being paid for locking things away for longer dated securities, is too high. So basically, the US are betting on the situation being sorted out in the longer term. Or you could say they're kicking the can down the road for when whoever is in charge at the moment is retired or no longer in charge. You can decide for yourself which one of those two you think is the case. So personally, if I took a long-term view, I'd be buying 20 and 30-year debt if I was the Bank of England and funding it with the issuance of shorter-term debt because they can take that long and longer-term viewpoint. It would soon sort the yield curve out, a bit of yield curve control. However, of course, they're not in charge of fiscal policy, which will be key in actually balancing the books or getting anywhere nearby. The bank isn't allowed to trade like this, of course, but it's a real shame because the only way a political system could allow long-term viewpoints to be taken is by having independent organisations like the bank do jobs like this. And of course, they're briefed by the government, but this would take some real ingenuity at government level, which I'm not convinced is there. So the remit needs organisation and it also needs yield curve control, which the Japanese have indulged in for decades and are doing okay, much as I would be highly uncomfortable if the UK debt was at Japanese levels, which is 216% of GDP as at the end of 2024 as debt. The thing that needs to be noted is often the Japanese debt is quoted without netting off the government's assets, which is a bit naughty to say the least, because you might have heard the Japanese are one of the very big owners, individual owners or nation owners of American debt. Apart from anything else, they own over $1 trillion. I think it's 1.15 trillion or so of US government bonds. So if you net those off, their number actually comes down to 78% of GDP. Guess what happens if you do the same in the UK? You get to 83.5% because their position in foreign assets, right, is so much better than ours is. So arguably, we're actually in a worse position than Japan. So as another segue here, this is why the fiscal rules have to be that tax collected matches public spending, but doesn't include investment. So if you imagine at a really simple level, if you collected, let's use the round numbers, is not quite correct, but if you collected £1 trillion worth of tax, you could spend £1 trillion on public spending and you could invest the rest that you spend. Maybe that's up to 200 billion. It's about less than that at the moment. It's somewhere above the 100 billion a year that there's room to invest. But if you invested that, and let's say you could get a 10% return, and the cost of that capital was 4% or 4.5%, then over time you would chip away at the debt because you would be balancing your payments out. Now look, you're spending 100% of what you're getting in. You're not setting any money aside, but you're still managing to do investment. As long as that investment is positive and does generate growth in GDP, then in that case, that growth in GDP will pay more tax, and that would actually chip away at the deficit in the long run. Now, this is the inherent problem, is that obviously not all the money is invested wisely. And do we always manage to stay underneath what we were seeking to spend? Well, we didn't in the pandemic, of course. We were spending way, way more than what we were getting in taxes on things like welfare, which would have included furlough. Doesn't mean that furlough as of right was a terrible idea, but what it means is if you're spending 100% of your tax take all the way along anyway, and then you have a problem, this is when government theoretically proves its value, right? So there's your problem. Okay, so that's what should happen. Note my use of the word should. So if you can get much bigger IRRs than you can borrow at, which we're always told about things where the government can get £27 return for every pound they invest and things like that. I'm not so sure about those, but you don't need those huge 2,700% levels of returns, 2,600% actually. You don't need those necessarily. You just need things that are going to return positive, but you need them to be big and meaningful aside from anything else. And of course, you need political will to be behind them, which is something that's often forgotten by economists, but it is very important, of course. So you could borrow at 4.5% for a wealth fund if you were going to make 9% plus. You know, Norway still has some government debt, $250 billion or so, 55.1% of their GDP, but their wealth fund is worth $1.75 trillion. Or they're at about 14% loan to value in the language we're used to, right? Now, they're also invested in stuff that's inevitably leveraged at about 30 to 40% or so. So it's quite as simple as that, but then it never is. Their drawdown rule is a spend of said fund at 3% a year as a cap. So that's $52.5 billion a year as it stands. And it costs them about $20 billion a year to service their debt. So that's based on current yields around 4%. So if you imagine they've got $32.5 billion a year before they start to spend, having already serviced all of their debt. What a fantastic, fantastic position that they're in. So that's the heavy stuff from Trump Watch. Why is that all in the Trump Watch section? Well, because he is influencing the bond yield so very much and has been nearly since he's been elected, but certainly since the whole tariff thing started. What's his response to all of this? Well, it's to tell the chairman of the Federal Reserve off and get the interest rate down. Unfortunately, what Mr. Trump doesn't understand is that if the Federal Reserve put the short-term interest rate down, because that's the only one they actually control, it might lead to things like the 10-year and the 30-year, which is very important in the US because it sets the mortgage rates apart from anything else. It might need to lead those yields going upwards, right? So this is another problem that I'm not convinced Mr. Trump understands. The best way of understanding this, Ray Dalio's got a new book out that's called How Countries Go Broke, The Big Cycle. If you want me to save you reading the whole book, in his précis of it, typical Ray style, you know, trying to sell fewer books. It's already a #1 New York Times bestseller, so he's not been successful in getting people not to buy it. But all three of these things are needed, right? You've got to raise the tax revenue. Remember, that's not the same as raising tax percentages necessarily. It's about collecting the most tax over the long term. You've got to cut the spending, especially from where things are at the moment, and you've got to achieve economic growth. Now, you see where Rachel Reed's mantra of growth, growth, growth comes from, which I've said many times is right in principle. It's the execution that's causing the problem. Then we had a bit of soap opera stuff. You know, they said two personalities as large as Donald and Elon couldn't stay in bed for long. And indeed, a little over 6 months looks to have been the shelf life. The left have been delighted in the public fallout, of course, but the centre are a bit more sanguine. Tesla stock went from 350 early in the week to 275 and back to 295 by the end of the week as the market closed for last weekend. The accusations you've seen, the ad hominem attacks don't interest me. It's solely a spectator sport. If it's your sort of thing, it's really not mine. But the 419 really is that the advertised 1 to 2 trillion Musk was going to save the government never happened. The big, beautiful bill is just crazy and adds 2.4 trillion to the deficit by the end of the decade, although it will most likely still allow for continued growth. So there is some proper analysis needed to take that into account as well. Compare that with the situation that I've already described in the bond markets, but you can see why the bond markets are overall a bit jittery, and they're also demanding healthy premia for both US and UK long-term debt, because the governments keep saying, yeah, we'll sort it, but there's no plan to do so within the next 5 years or so in the UK and within the next few years in the US. So when will it be sorted? And the bond markets are saying until we see some evidence it will be sorted, then we're still going to want extra money for long-term dated debt, because we don't trust there isn't bigger and bigger problems as time rolls on, which ultimately there are at the moment. So then we had some executive orders banning people from certain countries, echoes of Trump's first administration here. Drones being targeted, so big defence spending on drones, although apparently they last about 18 months before they're out of date. The tech moves so quickly, which must make government procurement and value for money basically impossible, I'd imagine. Excluding the press from certain events, so more classic free speech stuff there. And then a battle with the legal system in the US is also continuing. Firms actively suing the US administration. I can't remember it being this volatile in the US as far as I can ever remember realistically. And resultingly, that news drags our yield curves upwards, which happened again in the US. When the yield curves go up, ours go up like a mirror. Likewise, a couple of days ago, the US inflation data was released. It was lower than expected, and that dragged the UK yield curve down as well. So it does cut both ways, but we're like a prisoner to, hence why the Trump watch section keeps expanding in the supplement. Anyway, real-time property market, Chris Watkin, week 21 in the can, and it was bank holiday week, the week that Chris is reporting on. So 31,900 listings, still 5% ahead of 24, 9% ahead of pre-pandemic. 21,500 price reductions, still seeing 13.4% reduced every month. Last year, that was 12.1. 5-year average is 10.6. So we've got more stock and more reductions. That's absolute and relative. So my ready reckoner on that bit would be, we've got about 25% more reduced properties than in a normal market. 25% more. So that's significant, of course. And we've got about 10% more stock on than a normal market. I'm recanting back to pre-pandemic, to the last time we had a really proper normal market. 25,000 homes sold subject to contract, not bad for a holiday week and a bank holiday week. So we're seeing 8% more sold subject to contracts than 2024, 16% more than 2017 to 19, nearly keeping pace with 2022, which up to this point in 22 was still a very hot market indeed. Fall throughs are staying below the average, 21.7%, so only a little over 1 in 5. Long-term average is about 1 in 4. Net sales are looking good, just as the gross sales are. I always like to give Chris a bit of a shout out because he does such great work on the UK property market. His stats are brilliant. Check out his YouTube at Christopher Watkin. Okay, some macrobatics now, because we had a busy week. Nationwide and Halifax price index into one segment, and then the Bank of England money and credit report I always look at, especially on the money supply there, and also the final PMIs for May. So it was good news. So it definitely made it into that third slot. And then, of course, our usual gilts and swaps summary. So house price indices, a bit of a reversal. Nationwide said prices up 0.5% in May. Halifax said down 0.4%. They were the other way round in April, so it seems they've just got a bit of a lag one way or another, processing the same sort of data, maybe a bit of confusion after the stamp duty come down that I talked about last week. But Nationwide see 3.5% per year as the figure. Halifax see 2.5%. Both are now. Nationwide, I'm not sure I would completely agree with their summary because it's quite positive. They say unemployment remains low. Not sure which figures they're watching. I mean, it does remain low in historical context, but it's the highest it's been for several years. Earnings are rising at a healthy place above inflation. Well, that is true. Household balance sheets are strong and borrowing costs are likely to moderate a little if bank rate is lowered further in the coming quarters, as we and most other analysts expect. So that's the bit I'm particularly not sure I agree with, especially these days, although growth figures released the other day of minus 0.3% just for April will change things, but it should have been expected for April. The consensus economically ended up being minus 0.1%, which I was saying all the way through April looked like a negative month, but you're not going to judge too much by 1 month, which is why we look at quarters of GDP. Let's see. But, core inflation is not great at all. CPIH is above 4%. The governor's told the Treasury Committee relatively recently that the labour market loosening, they want to see cooling pay growth, and the bank's going to want to be gradual and careful. So I'll be stunned if he's not voting hold this month at the Bank of England meeting. And then Nationwide, for their bit extra, look at rural versus urban properties, looking at the last 5 years. Now, I don't know how useful this is because of the pandemic, because it distorted things massively, but they see in the 5 years, December 19 to December 24, prices up 23% in rural areas, 18% in urban areas. Perhaps no big surprise, a bit of a rush out of urban when working from home became more prevalent, apart from anything else. More room, more property for your money, usually, obviously per square foot and things like that, as a general rule anyway. Now, Halifax see the market down 0.2% this calendar year now. Kind of not what you wouldn't expect, really, with a market with a lot of stock available and stable interest rates. Well, they are stable. I still think inflation drags things forward. I only trust the ONS figures anyway, so I don't get too excited about Halifax. I've said many things about them over the years. Northern Ireland, Wales and Scotland are well ahead of England. Northern Ireland's still doing 8.6 year on year, according to Halifax, the other two doing 4.8. And then the North West and Yorkshire doing 3.7 year on year, with London at 1.2. So that's very similar to the ONS numbers. Now, Halifax are less bullish than Nationwide. They're very flat in their analysis for the rest of the year. Affordability a challenge, all depending on interest rate cut pace and the strength of income growth versus inflation. They say resilient. Sounds like they think flat, which I think is not a bad shout at the moment, although I do think inflation may well drag things forward still, and income inflation drag things forward. Okay, money and credit report, massive difference from last month. Last month was reporting on March, which obviously was before the stamp deadline. This month was reporting on April. So in March, 13.7 billion net was borrowed, a huge number for the month. In April, 0.8 billion net was repaid. So that huge difference. Net mortgage approvals fell to 60,500. So there's a bit of cooling there, because we were averaging about 65k for a few months in a row before the stamp distortion. But 60,000 is seen as the key number in the market. So no one will be disappointed with 60,500 mortgage approvals in April. And remortgages moved up to 35,300, highest number for many months. That's been languishing around the 30k mark, and it's up to more like 35 at the moment. Consumer borrowing went up sharply. I mean, that'll be a strong correlation between awful April from a bills perspective and the consumer's need for credit. They needed 1.6 billion net. Half of that was on credit cards, which is double March's number. And then the money supply was up another 6.2 billion, the M4EX, which is the measure that the bank prefers, on top of 12.7 billion in March. That doesn't feel and sound like a lower inflation scenario. Net mortgage lending stayed at up 2.5% for the year, very slow and steady. 2.7 was the figure the month before, March to March. But it's still much healthier than it was. It was negative, it was zero, it was in the low ones. 2.5 is much more positive and very, very sustainable, although mortgage lenders would hope for more. And a healthy housing market would see more as well, just to be clear. So lending to SMEs is almost non-negative growth at this point. I know that sounds strange, but since late 2022, and you know what happened then, SMEs have borrowed less and less money each year, which is still happening, but they're only down 0.8% year on year at this time. Big business, by contrast, has largely pressed on and is up 5.8 year on year. SMEs paid 6.79% in average in April, compared to 6.39 for large businesses, just so you know. Now, my favourite comparison in these figures is the stock mortgage rate. That's all mortgage debt outstanding at the moment in the UK. Residential mortgage debt, 3.86%, comparing to newly drawn mortgage rates, which in April were at 4.49 on average. So that's the real price that people are paying. That's the best way to think about it, rather than the best price, which in April times would have been around the 4% mark, but it would have been lower than that when those mortgages were offered some months before, because it's taking 5 months to get stuff over the line, 2 or 3 months to get the average mortgage to completion, for whatever reason in this current market. So the stock figure now is only 14% adrift of the drawn figure, much, much closer than it has been. And when this crossover point comes, I'd estimate it's probably 12 months away at the moment, or comes in the second half of 2026, when we draw at a cheaper rate than the outstanding stock. we can truly say we've been weaned off the cheap debt then, in that case, talking about households as a whole, and we've got through the interest rate normalization period, or whatever you want to call it. Okay, on to the PMIs. The flash PMIs were not good, and they were still below that magic 50 point as a whole. But with the numbers revised upwards now, the last week of May must have been a positive one for business. So the composite, the flash said 49.4, but the final number printed was 50.3. Services made a big contribution, moving from 50.2 on the flash to 50.9. But S&P dismissed this as marginal and much weaker than the long-run survey average. Can't argue with marginal, because 50.3 is about as marginal as you can get, and the long-run average is 53.3. The rest of the headlines, though: business optimism rebounds to a 7-month high, so basically getting over the doldrums of the budget. New work and employment continue to decline, though. Exports stable, new work decreasing for the 4th time in 5 months. So the economics director at S&P says May was a lot less uncertain than April, thanks to tariffs, apart from anything else. He points to the 8-month period in falling employment numbers as the longest streak since 2008 to 2010. And the final point is that price pressures have contributed to softer cost inflation after April's large cost increases. So the difference between the 50.9 services and the 50.3 composite is always construction and manufacturing. Manufacturing is 46.4, turbulent conditions, but an improvement on April's number, which was 45.4. 47.9 in construction was another improvement on April's 46.6, but it's still well short of the 50. Of course, house building, again, the weakest performing segment, printing 45.1. I think this is broadly known, and this is why the 1.5 million homes is such a pipe dream, apart from anything else. Positive outlook for construction going forward, though. Hoping for a tailwind in falling interest rates, they say, but I'm saying keep dreaming at the moment, unfortunately. Price pressures were more prevalent in May in construction, although the lowest price increases for 4 months. Job shedding was the steepest since August 2020, which is one thing that I picked out. Subby usage decreased to the greatest extent for 5 years. Doesn't sound great, but expectations are for a better 12 months ahead, which I think you would expect, really, and certainly from a housing perspective. You look, and commercial work in general, looking at liberalised planning, looking at all of that, you'd be hopeful it was going to pick up more. We've obviously seen more housing investment announced as well by the Chancellor. So did we get any pleasure, any guilty pleasure to discuss? Not really. Larger rate of earnings growth in the US, they're at 3.9. Their consensus was 3.7, but far more under control than the UK number. Moved the yields the wrong way, and as I said, they keep dragging them with us. But they opened the week last week at 4.175% yield on our 5-year gilt, and we closed at 4.154, so it trimmed ever so slightly. Thursday's close was 4.131, comparing to the swap of 3.789. That gets our discount back to where it's been for the many months at 34.2 basis points. So concerns from last week have abated a little bit. We remember we had a narrowing in that discount. 1 month ago, though, the 5-year swap was 3.602. 1 year ago, it was 3.995 for some historical context. So our best guess of limited company mortgage debt, 5.8 or so, and our safe range of 6% debt cost is still a realistic one to work from. So deep dive creeping on us once again, although we did go deep into Trump watch this week. As I said, I wanted to discuss regulations in the mortgage market in more detail because the changes have still not been what I was hoping for. But I still feel a summary review would be useful. But I got a report sent to me late on Friday night, thank you, from if the person is listening to this, that I wanted to share the output of with supplement listeners. So in keeping with recent supplement themes, this one was about subsidies and affordable housing, putting some real figures on the situation, a nice continuity piece, and the mortgage market will wait for 1 more week. I have to keep the source confidential, of course, but it is extremely well researched and runs to 80 plus pages. The subject matter is viability of affordable homes. Compelling language, 1.33 million households on local authority waiting lists, over 164,000 children in temporary accommodation, crisis calling for 90,000 social rent homes annually over the next 10 years, Tony Blair Institute calling for 700,000 social rent homes over the next 10 years, the housing permacrisis. Now, the real problem then, social and affordable rent homes do not pay their way. Right, affordable for this report is Capita LHA, which in itself is massively problematic when it's been divorced from the rental market, as it has been so many times since the first freeze in 2014. Capital value of the homes is significantly less than development costs, a big viability gap, not just because of the shortfall, because of the cost of capital over the lifetime of the homes, even when considering very long time horizons, far longer than the typical political time horizon. So only one option, of course, public subsidy to bridge this viability gap. This report concentrates on proper, well-researched numbers, and what do they say at the end of it? Ultimately, 20 billion is required, 20.35 billion per year if you use for-profit providers, or 18.84 billion if a housing association or council is the provider. If instead of delivering social rents, which tend to be about half of market rents, it looks like 7.75 billion subsidy for affordable, or 4 billion if the affordable is provided by an HA, council, or non-profit making organisation. So a big drop. And actually, Reeves has announced 3.9 billion per year. So that would mean all of that would go into affordable and none into social. And then the problem then becomes, as has been discussed before, affordable is not affordable for everybody by any stretch of the imagination. How robust is this conclusion that they've drawn in these numbers? Well, they've looked at 10 broad rental market areas across where LHA rates are equalised across one single BRMA. They've used the discounted cash flow model, calculating the IRR using differentiated assumptions. In plain English, it's been very properly done compared to some of the papers and publications that I review in this deep dive on a weekly basis. Assumptions that are used: 50-year time horizons for not-for-profit RPs with an IRR target of 5.5%. So when you look at that compared to the bond yield discussion, current 50-year bond yields are 4.65. So it doesn't leave a lot of margin above the cost of government debt. It looks very fair or even too low as an IRR for a non-profit maker. But there we go. The assumption after 50 years is zero exit value. For profit, the assumptions move to 7% IRR and a 30-year time horizon with an exit at investment value. Now, those assumptions look reasonable, although a longer discussion about nil exit value would be one consideration that we should bear in mind. They see a 100-house mix here in terms of what's needed as 22 beds, 43 beds and 44 beds. Apartment-wise, they use the 20-40-40 ratio, but 1, 2 and 3 beds by comparison. Costs are location-specific using BCIS, using published capitalisation yields for affordable housing assets. Very, very, very robust. The right way to go about this sort of stuff. Land value using residual land value methodology, as in start with the end value, consider any margin as required, consider construction costs, and then you'll end up with what the land is worth. Why not just use Section 106 agreements? Well, there aren't enough of them to deliver 90,000 homes per year. Apart from anything else, nowhere near enough. So the next point's a crucial one, right? This is a typical tragedy of the commons. The debt was cheap for 13 years by my reckoning, 2009 to 2022. Now it isn't. And the cost of capital is right in this debate at 4.5% for government bonds. It's a pretty good estimate of the 10-year bond yield over the last 18 months or more. The next point is very pleasing and often missing from governmental policy in this area. CEBR, the Centre for Economics and Business Research, who are a respected economics consultancy, who are very practical about policy and not really about politics, delivered a report last year looking into the economic impact of building social housing. Right, so there's a very good point well made here. There's a lot of positive economic impact on having affordable housing for a population. There's no real doubt or argument about that. I don't hear people arguing against it. The fact of the matter is that benefit goes to the country. It goes to the Treasury, right? And therefore, if the Treasury is providing subsidy, this should be and could be measured and offset against the subsidy that the Treasury is providing. AKA, it could start to become, and this is what some people have been calling for, critical infrastructure. Why are those words so important? Because critical infrastructure can be funded outside of the tax take, because essential or critical infrastructure investment is outside of the fiscal rules, as Rachel Reeves herself has framed them. She designed her own straitjacket, is one way of looking at it. But that definitional change needs to be made. And I'm dead sure that Angela Rayner will have been lobbying for that very, very hard, but that hasn't flown yet for whatever reason at number 10 or number 11, more accurately, who control many, many, many more of the policy decisions because they control the purse strings, right? So current funding, we've got about 12% of the subsidy needed based on the 2021 to 26, 2.3 billion a year. That's moved to 3.9. We know that this week in the spending review that came out earlier this week. But an average subsidy of 64,000 per affordable home. Well, unfortunately, social rent homes, you need about 170,000 per house and about 250,000 per apartment. And that's not for profit, bear in mind. So if you have a 50-50 split houses and apartments, and I know what you might think, because I did, well, why build any apartments then? Well, because you need apartments in high density urban areas. There's no other choice in London apart from to build apartments. I'm lucky, I live in a house in the suburbs, but bear that in mind. This is about what the people need, not what I need apart from anything else. So we average about 210,000 a unit, or 226,000 if using for-profit providers. So if you have a blend between the two, you're averaging out about 19.6 billion per year based on a unit subsidy of 217,600 as a blend between profit and not-for-profit providers, right? So this explains why Section 106 deliver affordable or shared ownership or something like that, intermediate rent, things like that, versus social rent. The current subsidy per house is nowhere near enough to deliver social rent homes. So the report's well written for its audience, although it can get a little bit complex in parts. But what do they suggest we do? Because I'm always keen on solutions, not just problems, right? Corporation tax credits are one potential solution, sorry. They've been used internationally with success in a variety of areas. Of course, they're open to abuse, but everything is. The model has been used with what's thought to be overall net benefit, and I'd agree with that assessment in the USA, for example. Fixing housing values at the planning stage is a process change, which sounds very sensible and practical. Only a solution can be proposed by someone who understands the problem well. The abolition of right to buy, it's made it harder and harder. We've made it harder and harder and less advantageous over the years, but politically no one wants to get rid of it, but it needs to be effectively got rid of, is the next bit of the jigsaw of the problem. And then the flex rent model, or the community rent model, the brainchild of Darren Rodwell, is also mentioned, the former Labour leader of Barking and Dagenham Council, who sadly did not make it into central government in the 2024 election due to a series of allegations beforehand that were dismissed. I'm the first to speak out against conspiracy theorists, but what I will say is from a policy perspective, Labour are worse off for not having Rodwell as part of the housing team. What is flex rent or community rent? Well, it's simple. When circumstances change, rent moves up or down. So instead of moving from a property where there are very likely to be roots and continuity as desired, instead the rent can adapt. Those who get the most help need it rather than an efficient model. Those who can get more play more, right? Now, rent convergence also comes into the conversation, although that's not formed a big part of the solutions here. There are a lot of providers pushing for rent convergence. What they mean is older social rents going upwards to reflect much more where they need to be rather than incredibly cheap and well subsidized, right? Now, next one's really key because there's two more key economic points here. Now, basically, politically, this problem hasn't had a lot of attention since 1980. We lost 375,000 homes from local authorities to their new owners in 1981 to 1984. Incredible for social mobility, but a one-off transfer of wealth because the money was not reinvested in building the same opportunities for future generations. It wasn't political. Labour did nothing to address this at all between 1997 and 2010. For delivering affordable housing, their numbers were shrouded in politics because they moved from social rent delivery to affordable rent delivery, thinking, well, the rising tide lifts the boats and people can afford affordable rents by definition, which of course they can't because it's an arbitrary definition. And so there was no social rent delivery, or it was very poor. Then, of course, we had a crash, which didn't help. And the Conservative government didn't get delivery back to anything like back to speed in that time afterwards, although they didn't actually do too badly in the latter half after the sort of 2015, 2016 level, although George Osborne drove a truck through things because he ruined the certainty that people have, or that providers had on rents, which has now been returned by Rachel Reeves, for which she deserves credit. And I'll be the first to make sure that is very clear. Rent stability, knowing that rents will go up 1% above inflation every year, is extremely important when looking at a 10-year plus time horizon. And they've got that certainty now for 10 years and hopefully for longer. Right now, onto mistakes made. Well, we would have had a 2% cost of capital, so a 3% IRR would have been fine. Now we need a 5.5% IRR for not-for-profit providers if we were using the average 10-year bond yield of the 2010s. But everyone who's ever closely looked at cap rates and commercial angles to property will tell you the difference between a 3% IRR and a 5.5% IRR requirement is incredible. But there's no point crying over spilt milk. Typical politics. Now we have to use words like permacrisis, and it's far more expensive and less workable than it was 10 years ago. So we need to recapitalise the housing association sector, according to the report. Can 19 billion annually be committed? Current commitment's 2.3. It's gone up to 3.9. Well, there's a great bit of financial engineering that exists in here. So just to put some context into those figures at the beginning, we went from 1.24 million in 2015 to 1.33 million in 2024 on waiting lists. So not really a per capita increase, actually, in those 10 years. But we've gone from 103,430 children to 167,000, an utterly unacceptable increase, of course. What about if we use that 2.3 billion or even the 3.9 billion to service index-linked government debt? Well, on that basis, because the rents go up with inflation, we can service the index-linked, because we've got inflation plus 1%, we can service those bonds with the rents, which would allow 180 billion of borrowing at 2.3 billion, right? It would allow more like 350 billion of borrowing or 320 billion of borrowing at 3.9 billion per year. So there's a huge amount of money that could be borrowed if we use the equivalence, the index-linked bond argument, which I think would probably keep the bond markets relatively happy. Look, there'd be a bit of friction. There's bound to be, right? There's always going to be some, you could argue you can also access the 2.3 billion temporary accommodation budget, strangely was the same as the social housing budget, apart from anything else, and get rid of temporary accommodation. It'll never happen because there's always going to be some frictional temporary accommodation, so you can't use all of that. We need some more colour from the CEBR report. But social rent homes are not for people in need, they are for people we need, right? So then it becomes an investment we can't afford not to make. So political courage needed. I think that's a point that Angela Rayner there, who I think arguably does have a considerable amount of political courage. We need a fundamental shift since 1984. The can is so far out of shape by being kicked down the road so many times. The economy's behind the 8 ball. It would be a fantastic change if someone could draw that equivalence between index-linked bond funding and how to get the money for these social homes, because the Treasury would get so much back for it if we built them. And of course, the economy would benefit from building all of these homes. We've then got to address things like capacity issues and things like that. Absolutely. But there can still be delivery for non-profit providers by the private sector if there is a lag in the fact that house prices are not moving up as quickly as they need to in order for developers to deliver more private stock to the market. And as I've analysed before, developers tend to bring the wrong sort of stock to the market because they want to focus on top-end homes where people can afford to pay for them, 4+ bedroom executive detached, etc., etc. Wonderful, lovely things that make fantastic Instagram pictures and all the rest of it, but they don't help to solve the housing crisis. Now, the developers aren't going to do that out of the goodness of their heart. They're there to make the most profit. So you have to use the other organisations like the non-profits who can do this sort of stuff. I hope that makes sense. One more shout out for the workshop and the early bird tickets, folks. Get your tickets below at bit.ly/PBW7. Joint ventures, mergers and acquisitions. Thursday, the 3rd of July in London. Really hope to see you there. And as always, as I always say, please remember to keep calm. Always listen to the supplement and carry on. There's plenty of opportunities this year towards 2030, and the risks around at this time, although they feel significant in geopolitics, are far less meaningful to the UK housing market than they have been for several years. Houses still look cheap in historical context. I cannot say that enough times. So, good luck.